Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Eastbuy Holding Limited interim report. Eastbuy Holding Limited offers a diverse range of businesses and services. At its core, the company engages in live streaming e-commerce for private label products in China through its live streaming channels, including Eastbuy Beautiful Life and Eastbuy Private Label. In addition to this, the company provides agricultural products under its private label brand. The company's offerings extend beyond retail and agriculture. It also provides software and technology services, education advisory, human resources, and related services. Furthermore, Eastbuy Holding Limited offers tourism and supply chain services. Notably, it also provides online education services specifically designed for college students and working professionals. The stock price of Eastbuy has skyrocketed by over 200% since July 2025, driven by a combination of strong financial performance, strategic developments, and positive analyst upgrades. One key factor was the company's turnaround to profitability in January 2026, with a significant increase in turnover and adjusted net profit exceeding market expectations. Eastbuy's Didong Yuhui strategy, which aimed to reduce reliance on individual personalities and focus on overall profitability, has also contributed to its growth. The company optimized personnel and reduced salary expenses by 34.9%, leading to improved financial health. Additionally, Eastbuy expanded its range of self-operated products, reaching 801 stock-keeping units (SKUs) across various categories. The company's diversified platform and offline expansion strategy have also played a significant role in its growth. Eastbuy has established a presence on multiple e-commerce platforms, including Taobao, JD, Pinduoduo, WeChat mini programs, and its own dedicated app. The company is also venturing into physical retail, with plans for its first offline experience store in Beijing. Furthermore, Eastbuy's investment in AI technology, particularly generative AI engines, has enhanced the precision of personalized recommendations and boosted transaction levels. The appointment of new executive president Sun Jin in December 2025 has also been met with positive remarks from Chairman Yu Minhang, who emphasized Sun Jin's problem-solving abilities and potential for business growth. Overall, Eastbuy's stock price surge can be attributed to a combination of strong financial performance, strategic developments, and positive analyst upgrades. The company's commitment to innovation, diversification, and expansion has positioned it for continued growth in the future. Eastbuy Holding Limited market capitalization of $30 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that Eastbuy Holding Limited holds a significant advantage in their industry. Eastbuy Holding Limited trades at a higher price-to-earnings ratio of 80 times and a higher price-to-book ratio of 4.9 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The balance sheet appears very conservative, with liabilities representing only 16% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have increased consistently as the company expands. Importantly, both assets and shareholder equity have grown at least 20% faster than liabilities, indicating that the business is expanding substantially and generating value after covering its obligations. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline are multifaceted and varied across different categories. On the growth side, expansion of private label products, growth in sales on various platforms such as Taobao and JD.com, and adoption of membership systems have been key contributors to revenue increase. Additionally, brand recognition and loyalty among customers, user research mechanisms, AI-enabled operational efficiency improvements, and personalized product recommendations have also played a significant role. Furthermore, the penetration of local characteristic agricultural products through live streaming and traceability has led to increased sales. Quality upgrading of upstream and downstream suppliers, R&D innovation in high-risk or high-profile product categories, and launch of new products meeting national and green product standards have also contributed to revenue growth. On the decline side, there are fewer drivers mentioned in the provided text. A decrease in interest income and a decline in trade purchases with Metropolis Holding have been identified as primary drivers of revenue decline. The company's financial performance indicates a strong ability to generate operating cash flow. The net cash generated from operating activities is a significant positive figure of RMB 278,558, as reported on page 37. This suggests that the company is efficiently managing its operations and generating sufficient cash to meet its financial obligations. Furthermore, there is no mention of negative cash flows or difficulties in meeting financial obligations throughout the report, which further reinforces the notion that the company is financially stable. Overall, this data indicates that the company is indeed generating positive operating cash flow. Management is emphasizing a multifaceted approach to drive company growth and expansion. The key strategies include adopting a multi-platform strategy to increase brand awareness, focusing on customer-centric principles through experience enhancement initiatives, and transitioning into a live streaming platform that combines product, technology, and cultural communication. A strong emphasis is also placed on quality control, with the establishment of regular quality inspection, reporting mechanisms, and a focus on producing high-quality products. The company aims to differentiate itself through its brand proposition of healthy, high quality, and good value for money. To achieve this, management plans to build a dual-core content ecosystem that integrates products and culture, leveraging content marketing across multiple platforms. In addition to these strategies, the company is investing in talent development, recruiting and training live streamer teams and professionals. This long-term approach is expected to drive growth, with revenue projections based on a capital asset pricing model using a discount rate of 16%. Overall, management's outlook is focused on creating a robust and sustainable business model that prioritizes customer experience, quality, and innovation. The company's financial activities have been focused on reducing the number of outstanding shares. One way they achieved this was through the repurchase of shares, where they bought back 90,122 shares, as stated in their report on page 36. Furthermore, they also disposed of their investment in preferred shares for a significant amount of $11,951,000, page 44. This disposal can be seen as another form of share buyback, indicating the company's efforts to consolidate its ownership and potentially increase shareholder value through reduced share count. Concerns have been raised regarding the potential for inventory buildup and supply chain disruptions, particularly with regards to private label products. The increasing costs associated with holding inventory are becoming a significant issue due to the rising gross merchandise value, GMV, of these products. This trend suggests that companies may be struggling to manage their inventory levels effectively, which could have far-reaching consequences for their operations and bottom line. That concludes the financial summary for East by Holding Limited. Feel free to comment below, and I will be happy to answer them when possible.